Think about making $100 million out of $1,000. Doesn't that seem like a fairy tale? For Warren Buffett, though, it's just another workday. For over 60 years, this financial wizard has outperformed Wall Street, and today, we're disclosing his trade secrets. Ever wondered why certain individuals seem to have a knack for handling money? It's not luck, and it's not magic either. An average person may become a market master by following this set of principles, 7 to be specific. Are you prepared to absorb the Oracle of Omaha's trade secrets? Greetings, prospective millionaires. Here's another video that'll change your financial game forever. Make sure to hit the notification bell, like, and subscribe before we reveal the money-making secrets. You won't want to miss the channel's upcoming events. Making it work for you is what we're talking about today. Not simply generating money. We'll learn how to think like a millionaire from Warren Buffett, who spent $3.17 on breakfast at McDonald's during the 2008 financial crisis. These are the guidelines that contribute to the establishment of an empire, not just recommendations. Now that class has started, get your notepads ready. The first of Buffett's golden rules is to save as if your life depends on it. Why? Because cash is the whole royal family when it comes to investing, not just the king. It's not about how much you make, but how much you keep. As Buffett famously said, "Do not save what is left after spending, but spend what is left after saving." This is a call to action for financial independence rather than just advice. Let's say you're creating a device that generates income. Your savings turn into a cog in that machine. It could seem slow and pointless at first, but compound interest, however, is where the magic happens. Buffett has built an empire on it, and Einstein called it the 8th wonder of the world. Start small, but do it now. Set aside $10 one week, $20 the next, and so on. As it moves down a slope, it's like a snowball gathering more snow, or in this case, more money. You'll have plenty of money to invest before you realize it. Recall that Buffett bought his first investment when he was 11 years old. Starting a snowball is something you can do at any age. But in a culture that promotes spending, how can you form the habit of saving? The pay-yourself-first approach is worth trying. Set aside a certain portion of your income for savings before you do anything else. Savings act as your pay, just like if you were your own employee. In his early years, Buffett lived on 10% of his income and invested the remainder. It sounds absurd to think about surviving on just 10% of your salary, doesn't it? But empires are built on that type of madness. One way to boost your savings is to automate it. Turn on recurring deposits into your savings account. It's similar to putting your financial development on repeat. Remember to monitor your expenses. To track where your money is going, use apps or a simple spreadsheet. Buffett once said, "You can't manage what you don't measure." The amount of money you're spending on things you don't even remember buying may surprise you. However, preserving entails more than just cutting expenses. It also entails increasing your earning potential. According to Buffett, the best investment you can make is in yourself. Develop new abilities, take up side projects, and bargain for more money. Your financial army grows with each dollar you earn. Don't forget that saving doesn't mean denying yourself. It's all about putting your future self ahead of fleeting pleasures. Be the one to plant the tree. Buffett says, "Someone is sitting in the shade today because someone planted a tree a long time ago." As you unwind in the shadow of financial independence, your future self will appreciate it. It's time to start using your money now that you've begun your snowball. Here comes Buffett's go-to approach: value investing. It's like bargain hunting, only you're searching for cheap businesses rather than clothes. In Buffett's words, value is what you get, price is what you pay. Imagine finding a $100 bill on sale for $50 as you go into a business. You would buy that right now, wouldn't you? That is exactly the goal of value investment. Businesses that are worth more than their present stock price suggests are what you're looking for. The goal is to purchase stock at a low cost, not to acquire them inexpensively. But in a sea of stocks, how can you identify these bargains? Start by examining the fundamentals of the business. It's comparable to checking the frame, tires, and engine when buying a used car. Think about their earnings, debt loads, and potential for expansion. Buffett favors companies with steady profits and minimal debt. He was said to have joked, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." At this point, things get entertaining and rather contradictory. What time of day is best to find these deals? While everyone else is in a frenzy. Buffett once said, "Be greedy when others are fearful, and fearful when others are greedy." When the market is tumultuous, good firms are sometimes pulled down with the bad ones. It's your opportunity to act quickly and purchase high-quality goods at a reduced price. Keep in mind that value investing isn't about earning quick cash. It's about finding a great company, buying it at a fair price, and holding on to it. What's Buffett's ideal holding period? Forever. Flipping stocks like pancakes is not his thing. He's putting together a portfolio of outstanding businesses that he can own in the long run. Think about it. You're buying a piece of a company, not just shares. If you bought a whole company, would you sell it a few months later? Most likely not. Maintaining it will allow you to enjoy the benefits of many years to come. That's Buffett's attitude about stocks. The catch is that value investing calls for perseverance and self-control. You may discover fantastic businesses, but you'll have to wait if the price is too high. You will be the one collecting the transfers if you are patient. As Buffett states, the stock market is a device for transferring money from the impatient to the patient. This is where a lot of investors go wrong. They want to know everything. They switch between tech stock, biotech, and real estate, presuming that diversification means having a general grasp of all of these areas. Buffett's counsel? Continue doing what you know. This is what he calls your circle of competence. Consider yourself a chef. You wouldn't choose to do brain surgery, would you? The same holds true for investing. Focus on technological companies if you're a tech whiz, and you can know a lot about pharmaceutical stock if you're an expert in healthcare. The famous quote from Buffett reads, "Never invest in a business you don't understand." If your circle seems small at first, don't worry. Like ripples in a pond, the idea is to expand it gradually. Learn from professionals in your field, read industry research, and keep up with the company news. Approximately 80% of Buffett's time is spent reading. According to him, that's how knowledge builds up, like compound interest. Every article you read and each annual report you look at improves your ability to make investments. One useful piece of advice is to consider whether you could explain a company's operations to a 10-year-old before investing in its stock. If not, it might not be the right time for you. Saying, "I don't know," and turning down an investment opportunity is acceptable. As Buffett puts it, the stock market is a no-call strike game. You don't have to swing at everything. You can wait for your pitch. Here's where it truly shines, though. You're unstoppable when you combine value investments with your circle of skills. You're searching for undervalued business in sectors that you are knowledgeable about, not just any undervalued company. The magic happens at that point. Keep in mind that broadening your sphere of influence is a continuous activity. Buffett didn't suddenly become an authority in railroads, soft drinks, or insurance. He learned, studied, and progressively expanded his knowledge. You can too. You have the chance to broaden your network and get more knowledge about the corporate world every day. Therefore, begin where you are. Make use of your knowledge and progressively broaden your ideas of expertise. You'll soon be spotting investment possibilities that others overlook because you have knowledge that others don't. The best companies, in Buffett's view, are strongholds rather than merely prosperous businesses. They possess a long-lasting competitive edge that deters rivals, which he calls an economic moat. Think about corporations such as Apple or Coca-Cola. Even when there are less expensive options, people still buy them. This is a moat's power. Buffett says the products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. He compares it to owning a toll bridge, which requires annual fees to cross. However, there are several types of moats, and identifying them is where you as an investor can truly excel. Let's dissect them. The Coca-Cola effect is a term used to describe brand power. When people are willing to pay more for a certain name, a moat is created. Think about basic goods, like Heinz ketchup, or high-end brands like Rolex. Cost advantage. Walmart consistently undercuts rivals thanks to their superior supplier network. Customers return for the lower prices because of that moat. High shifting costs. Switching to a competitor is expensive and disruptive. Once a company has used Oracle databases or Microsoft Office, a moat like that keeps clients locked in. Network effects. Facebook and LinkedIn become more useful as more people use them. With every new user, that moat gets stronger. Regulations and patents. Airports with government-granted monopolies and pharmaceutical companies with copyrighted medications both enjoy legal protections. Finding long-lasting moats is the problem. Think about whether this company's advantage will still be there in 10 or 20 years. As Buffett said, in business, I look for economic castles protected by unbreachable moats. If that's the case, you could be onto something important. The exciting element, though, is that moats can change and adapt. A business may have a financial edge at first and then develop strong brand loyalty. Alternatively, a network effect might lead to high switching expenses. As an investor, it will be your responsibility to recognize these moats, comprehend their workings, and purchase before the market does. Keep in mind that a moat serves many purposes than only just protecting from rivalry. The goal is to create a business that is resilient enough to weather any storm. While many businesses suffered during the 2008 financial crisis, Buffett's moat-protected businesses prospered. That is the power of corporate castle investments. Therefore, don't just examine if the company is currently profitable when thinking about potential investments. Ask if it has a moat that will sustain its profitability over time. You build a portfolio that not only endures, but flourishes that way. We need to talk about money accounts, so don't flee. Uninteresting? Perhaps. Crucial? Of course. Buffett studies these literature for hours on end. They're similar to a company's report card, and you need to know how to interpret them if you want to invest like Buffett. According to Buffett, accounting is the language of business. Therefore, you need to be familiar with the lingo if you want to talk about business. Like learning a new language, it seems challenging at first, but once you get the hang of it, a whole new world becomes accessible. Let's divide it into 3 important documents. Consider the balance sheet as a moment in time showing the state of the company's finances. It displays the assets and liabilities of a business. The difference is the equity or net value of the business. Buffett favors companies with strong balance sheets, meaning they have a lot of assets and little debt. The income statement illustrates the company's performance over time, much like a movie. It shows the amount of money a company has made or lost over time. Buffett anticipates steady earnings growth in the future. The actual money coming in and going out of the company is tracked by the funds flow statement. According to Buffett, cash is king. A business may appear prosperous on paper, but it may be having problems if it isn't making money. This is when the exciting part begins. You need to be able to read between the lines because these statements tell a story. Keep an eye out for trends. Are profits rising steadily? Does the business have good cash flow? What's the ratio of its debt to equity? Here's some expert advice straight from Buffett. Read financial reports carefully, especially the footnotes. As he recently said, I always read the footnotes. They are much more revealing than management letters to shareholders. The genuinely juicy information, such as potential hazards or accounting practices that could paint a more positive picture than reality, is often found there. Don't be overwhelmed though. Start small. Examine the most recent annual report of a company that piques your curiosity. Focus on understanding each area separately. you'll start to see trends and understand the meaning of the statistics as you practice. Recall that mastering financial statements interpretation is like acquiring superpowers in the realm of investing. This step is usually skipped because it seems too challenging or boring, but this is to your advantage. You'll make wise decisions based on accurate information, whereas others base their investments on gut feelings or news reports. You may lower your risk and improve your chances of success by learning to understand financial accounts. As Buffett once said, risk comes from not knowing what you're doing. Although it's not always thrilling, fortunes are made this way. Let's now examine time, which is one of the most misinterpreted aspects of investment. A lot of individuals think that predicting market movements is necessary for successful investing. By trading in and out based on hunches or news, they try to time the market. Buffett? That's not a game he plays. Buffett timed his individual stock investments instead. In order to find companies that are selling for less than their liquidation value, he employed the net-net technique. It would be like paying less for the bricks for a home. Be greedy when others are fearful, and fearful when others are greedy, he famously said. However, what is the practical application of this? It all comes down to patience and determination. Buffett frequently waits years until the right time. He looks for reputable companies whose stock prices have dropped as a result of transient issues of market overreactions. According to him, they are wonderful businesses at fair prices. Consider yourself at a sale. You see that a premium item that you've had your eye on for a while is now on sale. Buffett watches the stock market for that moment. He's looking for outstanding businesses at fair rates, not inferior businesses at reduced costs. The stock market is a no-called-strike game. You don't have to swing at everything. You can wait for your pitch. Buffett likens it to baseball, where missed pitches don't result in a penalty. Investing is no different. Hundreds of investment opportunities may slip by while you wait for the perfect one. The crucial thing, though, is that you have to act swiftly when the ideal opportunity presents itself. When you see a great company at a fair price, don't hesitate. Buffett once said, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Invest with faith. Extreme discipline is required for this method. You have to resist the urge to act only for the sake of acting. The noise must be ignored, including the daily fluctuations of the market, popular ideas, and the fear and greed that drive the majority of investors. Rather, you study, wait patiently, and make plans for when everything will fit together. Buffett is not interested in quick flips. Therefore, keep in mind that his holding period is ideally forever. As he states, our favorite holding period is forever. Purchasing shares makes you a co-owner of the business, rather than just a trader looking to make quick cash. The long-term perspective is essential. It allows you to focus on the fundamental value of the company and disregard transient market fluctuations. It is comparable to planting a tree. You don't dig it up to look at the roots every few months. You plant it in good soil, give it water, and watch it grow. What about market meltdowns, downturns in the economy, worldwide pandemics? Here's where Buffett's approach really pays off. He views these circumstances as opportunities rather than disasters. Buffett bought during the 2008 financial crisis when the majority of investors were in a panic. By making billions of dollars worth of investments in companies like General Electric and Goldman Sachs, he was able to secure favorable terms that would eventually pay him handsomely. The contrarian mindset requires steel nerves. He famously stated in an opinion piece during the crisis, "Be fearful when others are greedy, and greedy when others are fearful." When everyone else is selling, it's hard to buy. However, Buffett made his fortune in precisely this manner. How can you apply this to your personal investments then? Start by practicing patience. Do not feel pressured to buy or sell all the time. Make a list of outstanding companies that you would like to acquire. After that, watch for the right price. You'll be ready when the time comes, even if it takes months or even years. Think long-term while making an investment decision. Think about it. Would I feel at ease running this company for 10 years, 20 years? You could have found a Buffett-style investment if the answer is yes. Keep in mind that investing time is not about making predictions about the future. It all boils down to seeing a value when you see it, having the forbearance to wait for the right time, and having the courage to take decisive action when the time arrives. Let's now talk about the controversial topic, diversification. You've probably heard the old saying, "Don't put all your eggs in one basket." For most investors, it's sound advice. Buffett, though, he has a unique viewpoint. Buffett supports diversification, but in moderation. As one of the most successful investors in the world once said, diversification is protection against ignorance. It makes little sense if you know what you're doing. This may seem odd, but let's review it nonetheless. You might be surprised by Buffett's perspective on diversity. He has no desire to own hundreds of stocks. He did say that, in fact, wide diversification is only required when investors do not understand what they are doing. But what was he trying to say? You can add a business to your portfolio if you've done your research and have a solid understanding of it. Think about this. Would you limit your investment to 1% of your portfolio if you had the chance to invest in Amazon at an early stage and truly understood the company's potential? Most likely not. You would want to take a big stand. Buffett's approach is this. He advises against allocating more than 10% of your portfolio to any one stock, but he concentrates on his greatest ideas inside that framework. It's similar to avoiding putting all your eggs in one basket while avoiding using too many baskets to carry them. The caveat is that this approach only works if you know exactly what you're doing. Buffett studies companies, industries, and economy trends for many hours. He only puts money into companies he is well familiar with. According to him, risk comes from not knowing what you're doing. A certain amount of variation is necessary for the majority of us. Spread your holdings throughout a variety of industries and asset classes. In this way, your entire portfolio won't collapse if one market sector experiences a setback. Remember to diversify internationally. The world is big, and there are great companies all across it. Warren Buffett has stated, "If you told me I could invest in the US for the rest of my life, I would take it. But it wouldn't be my first choice." How can you apply this to your personal investments then? Prioritize quality over quantity first. Focus on a small number of excellent businesses that you really understand rather than trying to own a piece of every company in existence. Do your homework. Examine the annual reports, recognize the risks, competitive advantages, and business plan for each organization. You should consider adding a business to your portfolio only once you feel you've had a solid grasp of it. Recall that Buffett himself diversifies. His holding company, Berkshire Hathaway, owns dozens of companies and has investments in several others. The trick is to figure out what focus and variation works best for you. You could find that a more focused portfolio works better for you as your investment experience increases. Err on the side of caution for the time being. According to Buffett, rule number 1, never lose money. Rule number 2, never forget rule number 1. You have studied the 7 golden laws of investing as outlined by Warren Buffett. Here's the big question, or perhaps I should say, the billion-dollar question. What is the ultimate secret that ties all these rules together? It's not only about making wise financial decisions. Establishing the billionaire mindset is the goal. This mindset is the foundation that turns regular investors into extraordinary wealth generators. The long-term perspective is emphasized by the billionaire mindset. It involves seeing opportunities where others perceive obstacles, waiting patiently for the right moment, and having the courage to take decisive action when that moment comes. It involves constant learning, unwavering commitment, and the ability to think clearly in a cacophonous and distracting setting. By adhering to Buffett's 7 principles, you're rewiring your brain to think like a billionaire, in addition to learning financial concepts. You're creating the same mental model that let Buffett go from being a paperboy in Omaha to being one of the richest people in the world. Your ultimate reward is represented by this mindset. It's the gift that never stops giving, allowing you to see chances, stay out of trouble, and gradually build up lasting riches. The billionaire mindset is essential to achieving financial freedom, regardless of starting with $100 or $100,000. Are you ready to adopt a billionaire's mindset? Are you prepared to see the world from Buffett's perspective? You will have found the ultimate secret to long-term wealth if you can learn to think like this. You may choose to embrace the remarkable or settle for the commonplace. Recall Buffett's statement. The difference between successful people and really successful people is that really successful people say no to almost everything. Start by saying yes to prudent investments and no to everything that doesn't align with your long-term financial goals. Now is the beginning of your path to billions. What will you do first? Everyone, there you have it. The 7 Golden Rules of Investing by Warren Buffett. These are the strategies that made a curious boy from Omaha one of the richest people in the world. From saving like a squirrel to hunting for value like an expert. Keep in mind that investing isn't about getting rich overnight. Without a doubt, the goal is to get wealthy. Why not plant your own tree now? Buffett once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." The problem is that knowledge is just the first step. When you use these ideas, the real magic happens. Begin modestly, but begin. Read your first annual report, buy your first stock, and open that savings account. Keep in mind that making money isn't the only aspect of successful investment. It involves becoming more patient, making more disciplined judgments, and strengthening one's ability to think. Buffett states unequivocally that the most important investment you can make is in yourself. Therefore, continue to study, grow, and invest in the market as well as yourself. That's all for now, aspiring business magnates. You know what to do if you like this video. Subscribe, like, and comment, and don't forget to forward this to a friend who could benefit from some financial guidance. Till next time, keep investing, learning, and saving.